Hey everyone! Today, we're diving into the book Beyond Wall Street by Ken Arnold, a fantastic guide for anyone looking to expand their investments beyond the stock market. In this book, Arnold breaks down the world of alternative investments, from real estate and precious metals to venture capital and peer-to-peer lending. Whether you're new to investing or an experienced investor looking to diversify, this book is full of practical strategies you can apply today. I'll be walking through each chapter in detail and showing you how to implement these strategies into your daily life. Let's dive in. This is Wealthvelocity. Here you create, protect, and grow your wealth fast. Chapter 1. Understanding Alternative Investments. Ken Arnold opens the book by introducing the concept of alternative investments, anything that isn't a traditional stock, bond, or cash holding. These investments include real estate, private equity, commodities, hedge funds, and more. The key takeaway from this chapter is that alternative investments can provide diversification and reduce the risk associated with holding only stocks and bonds. Arnold emphasizes the importance of broadening your investment portfolio to include different asset classes, which can help mitigate risks during market downturns. To start, evaluate your current portfolio. If you're primarily invested in stocks and bonds, consider diversifying into alternative asset classes. Begin by researching options like real estate, private equity, or even collectibles that interest you. Allocating 10 to 20% of your portfolio to alternatives can add balance and reduce volatility during market corrections. Remember, the goal is to reduce risk by spreading your investments across different sectors. Chapter 2. Real Estate as an Investment Vehicle. Chapter 2 goes in-depth on real estate, one of the most popular and accessible alternative investments. Ken explains how real estate offers multiple ways to build wealth, whether through rental income, property appreciation, or flipping homes for a quick profit. He also talks about the leverage benefits of real estate, where you can use borrowed money to increase your return on investment. Finally, Arnold touches on REITs, real estate investment trusts, which allow investors to get involved in real estate without owning physical property. Start by deciding what type of real estate investment aligns with your financial goals. If you're looking for passive income, rental properties are a solid option. You can start small by purchasing a duplex or a single-family rental. For those who prefer a hands-off approach, consider investing in REITs, which allow you to invest in real estate without dealing with tenants or property management. If you're hands-on, house flipping might be appealing, but be sure to research the market extensively and understand the renovation costs involved. Regardless of your approach, always run the numbers to ensure that your investment will generate a positive cash flow. Chapter 3. Commodities and Precious Metals. Chapter 3 explores commodities like oil, natural gas, and agricultural products, as well as precious metals like gold and silver. Arnold explains that commodities can be a great hedge against inflation and economic uncertainty, particularly when traditional markets are struggling. Precious metals, especially gold, have long been considered a safe haven asset during times of market instability, offering protection against currency devaluation and stock market crashes. To get started with commodities, consider allocating a portion of your portfolio to gold, silver, or other precious metals, usually around 5 to 10%. You can invest through physical assets like gold bars or coins, or through ETFs that track the price of commodities. For more advanced investors, commodity futures can offer opportunities for high returns, but they also carry higher risks. By diversifying with commodities, you're creating a safety net against inflation and economic downturns, ensuring your portfolio has some protection during periods of volatility. Chapter 4 delves into private equity and venture capital, two high-risk, high-reward types of alternative investments. Private equity involves buying shares of companies that are not publicly traded, while venture capital focuses on funding startups with high growth potential. Although these investments can generate massive returns, they come with high risk and long holding periods. Arnold explains how these investments are typically reserved for accredited investors, but are increasingly becoming accessible through crowdfunding platforms. If you're interested in private equity or venture capital, start small with crowdfunding platforms like AngelList or Seed Invest. These platforms allow you to invest in startups with a lower capital commitment. Keep in mind that these are long-term investments, often taking several years to see returns. Diversify by investing in multiple companies rather than putting all your money into one startup. Remember, while the potential for high returns is there, these investments are highly illiquid and risky, so only allocate money you're willing to lock up for several years. In Chapter 5, Ken Arnold discusses hedge funds and managed futures, two types of investments that utilize more advanced strategies like short selling, leverage, and derivatives. Hedge funds are often designed to protect against downturns by employing tactics that profit in both up and down markets. Managed futures, on the other hand, allow investors to gain exposure to commodities, currencies, and other markets through futures contracts. Hedge funds and managed futures are typically limited to accredited investors, but you can gain similar exposure through mutual funds and ETFs that mimic these strategies. For instance, market-neutral or long-short funds can provide the same risk-reducing benefits as hedge funds without the high minimum investment requirements. If you qualify as an accredited investor, consider investing in hedge funds or managed futures as part of your portfolio to reduce correlation with the stock market, offering a hedge during periods of volatility. Chapter 6 introduces tax lien investing, which involves purchasing tax liens, claims against properties that owe back taxes. Tax liens can offer high returns if the property owner pays off the debt with interest. In some cases, if the property owner fails to pay, the investor may even acquire the property at a significant discount. However, this type of investment requires a deep understanding of local real estate markets and tax laws. To start with tax lien investing, research your local county's tax lien auctions. These auctions are often conducted online, allowing you to bid on liens from the comfort of your home. Be sure to thoroughly research the property tied to the lien, including its value and condition. Additionally, consult a real estate attorney or tax lien expert to guide you through the legal process. This type of investing can generate high returns, but also carries risk, so proceed with caution and do your homework. Chapter 7 highlights the rise of peer-to-peer, or P2P, lending and crowdfunding as alternative investment options. Peer-to-peer platforms like Lending Club allow individuals to lend money to borrowers in exchange for interest payments, often providing higher returns than traditional savings accounts or bonds. Similarly, crowdfunding platforms like Fundrise enable you to invest in real estate projects or startups with smaller initial investments. To get started with P2P lending, consider platforms like Lending Club or Prosper, where you can diversify your investments across multiple loans to reduce risk. Be mindful of the borrower's creditworthiness and diversify your loans to protect against defaults. For real estate crowdfunding, platforms like Fundrise or Realty Mogul allow you to invest in real estate with as little as $500. Both P2P lending and crowdfunding give you access to investments that were previously only available to institutions, allowing you to generate higher returns on your capital. Chapter 8: Cryptocurrencies and Digital Assets. In Chapter 8, Ken Arnold discusses the growing world of cryptocurrencies, including Bitcoin, Ethereum, and other digital assets. He explains how blockchain technology is revolutionizing industries beyond finance and why some investors see cryptocurrencies as the future of money. However, Arnold also highlights the high volatility and regulatory risks associated with digital currencies. Cryptocurrencies can be a high-risk, high-reward portion of your portfolio. If you're new to crypto, start by allocating a small percentage, no more than 5%, of your overall portfolio to digital assets like Bitcoin or Ethereum. Use well-known exchanges like Coinbase or Binance, and always store your assets securely in a wallet. Alternatively, you can gain exposure to blockchain technology by investing in companies that are adopting or developing blockchain solutions. Remember, cryptocurrencies are extremely volatile, so invest only what you're willing to lose. Chapter 9 takes us into the world of art and collectibles, unique assets that can appreciate significantly over time. Arnold explains how investing in art, rare coins, vintage cars, and even wine can provide both enjoyment and financial return. However, these markets require specialized knowledge, and liquidity can be a concern, as it may take time to find buyers for these assets. If you're passionate about a specific collectible, whether it's fine art, vintage cars, or rare wines, start by building your knowledge base. Attend auctions, visit galleries, and network with collectors to understand what drives value in that market. You can also explore fractional ownership platforms like Masterworks, where you can invest in high-value art without buying entire pieces. Remember, collectibles should be a small part of your portfolio, as they tend to be less liquid and more speculative. The final chapter pulls everything together by discussing how to build a diversified portfolio that includes alternative investments. Ken Arnold explains that alternative assets, when added to traditional investments like stocks and bonds, can lower portfolio volatility and improve risk-adjusted returns. By investing across asset classes, you're better prepared for different market environments. Take a step back and review your overall portfolio. Consider what percentage of your investments are in stocks, bonds, and cash, and what percentage is allocated to alternative assets. Aim to allocate 10 to 30% of your portfolio to alternative investments like real estate, precious metals, peer-to-peer lending, or private equity. By spreading your risk across different asset classes, you'll create a more resilient portfolio that can weather different economic cycles. And that's a wrap on Beyond Wall Street by Ken Arnold. This book offers a comprehensive look at alternative investments and shows how you can diversify your portfolio for long-term success. Whether you're interested in real estate, commodities, or venture capital, there's something in this book for everyone. The key takeaway here is that there's more to investing than just the stock market, and by exploring these alternatives, you can reduce risk and potentially increase returns. If you found this summary helpful, be sure to like this video, subscribe to the channel for more insights, and check out the link in the description to grab your own copy of Beyond Wall Street. Thanks for watching and happy investing. See you in the next video with more money in your pocket.